One of the big items that's been sort of out there from the Biden perspective is an increase in taxes for people making over $400,000. So we're going to try to cut through some of the rhetoric here and tell you what we know right now and what it might mean for you and for your decisions this year and going into future years. So I think we'll start with one of the big headlines, which is the repeal of I think they were the Trump tax cuts and what that might look like. So Neil, just give us some perspective on what's being said there.
Yeah, and what Will's referencing there is the TCJA, which was basically a Tax Cut and Jobs Act that was approved back in 2017 and went into effect basically in 2018. The big change there was the change in the tax brackets, and where Biden's proposal is really focusing right now is changing the top tax bracket from 37% back to the pre-2018 39.6. And keep in mind, this is already planned to sunset in 2026, just naturally. But what Biden wants to do is really accelerate that to 2021. Currently, here in 2020, that 400K that's being proposed, if you're a single filer, you'd fall right in the middle of the 35% tax bracket and have a lot of room about 100K before you get to the 37%. And then joint filers would be in the 32% tax bracket. So what's being proposed here is pretty significant right now. As we think about that 400K, if you're single, that's 39.6%. So that's basically an increase of 4.6% on single filers. And then from a joint standpoint, what's the biggest thing to point out here is they're wiping out the 35% tax bracket. So really jumping from 32% to 39% for anyone who makes north of $400,000.
If this is likely to go through, what other implications might this have for individuals?
Well, obviously, a big impact on take-home pay. You want to make sure that if this is going to go into effect and you're in this tax bracket, then there are some opportunities you might want to think about just from accelerating income. If you do have the opportunity to do that here in 2020 versus 2021 and beyond, or even considering Roth conversions, that's ability to move money from a pre-tax IRA to a Roth IRA by accelerating the payments of those income taxes on those dollars. And those are going to be very unique to each individual situation, where they might fall into those brackets, and then obviously the type of wealth you have as well.
Another component of the proposed Biden tax plan is an increase in the Social Security tax and how that might be implemented. Right now, what we're understanding is incomes over $400,000 would begin to be subject to the Social Security tax again, because right now it's limited. So maybe Neil, walk through what that might mean and what implications that might have for current year planning.
Yeah, and as you look at the way the Social Security tax is currently implemented, you're paying Social Security tax up to $137,000 right now, $137,700 to be exact, here in 2020. And right now, that's scheduled to continue to inflate each year. But as Will's mentioning, what's being proposed is basically starting that Social Security tax back up on income north of $400,000. So currently, as you look at the 6.2 tax on that can be pretty significant. If you are above that $400,000 mark. So going back to that conversation around even thinking about strategies of maybe even accelerating some income to make sure you're flying under that radar of that $400,000 mark.
Yeah, that's a good strategy. And again, consult with your tax advisor. But these are things sort of we're entering a regime of potential future tax increases. So everything you sort of are planning for needs to be considered today and long term.
Yeah.
So let's take a turn here and look at some of the estate planning taxes that are being proposed and what the Biden plan might implement in terms of estate planning. So walk us through what we know there.
Yeah, and Biden's goal is to take us back to the good old days, before the Tax Cut and Jobs Act. But basically, the proposal is to half the current lifetime exemption amount of $11.58 per person, and bringing it back to the President Obama era of the inflationary increase each year. So prior it was like in the 5 million range, but with inflation, it's going to be right around $6 million per person. Again, this is already scheduled to sunset here in 2026, but Biden's proposal is accelerate that to 2021 right now.
Okay, so essentially it would be cut in half from the 11.3 roughly.
Exactly.
And we've also seen proposals where it could be even reduced further, correct? I think there's been some that it could go back to the $3 million inflated range. So what implications does that have for somebody sitting here thinking that that's a high probability outcome?
Yeah, it's definitely impacting a lot more individuals and families out there, because if you think about, where it's currently at today, roughly $12 million per person, there's a lot more individuals out there with $6 million than $12 million. And same thing with families from $24 million to $12 million. So when we start to look at that from an individual standpoint, some things you want to consider and start to be thinking about is just first and foremost, understand, the wealth it takes that you need to live the life that you want and to live the life of your dreams. Because from a planning standpoint, if you're concerned about some of these estate tax limits and levels, the first thing you don't want to do is just give away money just to give away money to avoid estate tax. Because obviously you do not want to be asking your children for money, if you decide to give it away in this generation. Another strategy, which we talk about a lot, is just spend it all, just to get underneath those limits. Have a little bit more fun, while you're alive, and make sure that you don't incur a big tax at the end. But more near term, some things that you can consider. Life insurance is something that adds to your gross estate. So if you do exceed these limits, it's not a tax-free benefit. So moving life insurance out of your estate into an irrevocable life insurance trust is a very common strategy that's picking up a lot more conversations. So when you do pass away, that money is not taxed in your estate, and then maybe your children or your beneficiaries can use that money to pay for other estate taxes that you might incur. Spousal access trust is another idea that's out there, where you're gifting at the same generational level. So you're not actually giving it away to another generation. So your spouse can still access that for health, education, maintenance, support. So that's another strategy that you can think about, here before even the end of 2020, to maybe accelerate some of those gifting limits.
Great. And do you have to make the change with the insurance this year, or can that be done post this year?
Well, those gifting limits are going to apply to the year that money is gifted into that irrevocable trust. But keep in mind, the cash value of that policy, if it has a cash balance, or even the death benefit. There's a formula that really factors in what that value of that gift is. So if you gift a $2 million policy into an irrevocable life insurance trust, that $2 million death benefit is not considered the gift value. So keep that in mind.
Okay.
So there's still a way to shift, future wealth at a lower dollar cost out of your estate today, and even into 2021.
Great. One of the other items that's embedded in that proposal that I don't think we have great clarity on, but it has been mentioned, is the step up in basis or mark to market tax on assets that are transferred. So you walk us through what the proposal is there and what we might see.
Yeah, absolutely. And when we think about the step up in basis, this is another action that goes into effect when you do pass away. And currently, when you pass away and money is going to your beneficiaries, there's a step up in the cost basis. So if you if you have a cost basis of $10,000 and say Amazon, now it's worth $1 million. When your beneficiaries inherit that, the step up in basis goes up to $1 million. So there's no tax on that transfer there. So what's being proposed is to eliminate the step up in basis, but what's not clear is what's going to go into effect. Whether it's going to be a carry forward basis or even treated as a sale upon death. So those are two things that are not clear right now, but this is definitely an agenda item that we want to watch closely.
And if you're thinking about maybe shifting gears to being more charitable this year, does it make more sense to be more charitable now, or wait until after the election and a potential change in tax law?
Well, we definitely want to expand on the limitation on donations or even deductions as well. But even thinking about this conversation around the step up in basis, if this goes away, there's an ideal opportunity here just based on gifting highly appreciated stock into a donor advised fund or to your favorite charity. Essentially what this will do is avoid the capital gains tax for you, and you get the full write-off for your donation, and then two, create a step-up in basis if you wanted to buy that security back, which would avoid the potential change here as well.
Right. Hopefully that won't get eliminated going forward.
Well, I mean, the probability of this getting eliminated it's pretty low, at least at this point. It's actually happened twice here over the last 50 years, 1976 and again in 2010. The one in 76 was repealed a few years later, never was fully implemented. There's a lot of delays from the financial institutions. And if you recall, more recently in 2010, that lasted for basically a year. So it's definitely something that's been tried before, but the issue is with the financial institutions, the compliance behind it, and just regulating it from the IRS standpoint is very challenging to do. And if you recall, Will, in 2010, as a big Yankees fan, that was coincidentally the year that George Steinbrenner passed away, where there's no estate tax with I think he had a net worth of 1.4 billion at that point.
Right. That's right.
Yeah.
I do remember that. Sad days.
Sad day. But a good year, I guess, to pass away with that net worth.
Yeah. So one of the other big headline tax proposals that's coming out of the Biden camp is an increase in the capital gains tax rate, which we've been doing a lot of research on from an investment standpoint, and what types of behavior we've seen in the markets when there's been an increase in capital gains rates. And so we've got some of that will be coming in one of our other videos. But generally speaking, we do see a sort of a rush to capture gains and pay taxes on them at a lower rate. And then once the rate is enacted, we see quite a bit of holding. People are just reluctant to sell because they're really not willing to pay that higher tax. So talk about the potential impact of a higher capital gains rate.
Yeah, absolutely. And keep in mind the magical number for the income tax rate is 400K. For the capital gains increase, the magical number is $1 million in total income. So when we look at that, the long-term capital gains rate and qualified dividend rates for income over $1 million is going to go up to 39.6. But keep in mind, there's the surcharge on top of that, about 3.8%. So the total rate on that transaction is going to be 43.4%. So that's a huge change, basically almost doubling to where it's at right now at the 23.8% rate. So that right there has a lot of planning opportunities when you think about the jump in the tax of above $1 million.
And that tax rate is based on ordinary income. So if you have ordinary income, is that correct?
Well, when you look at the calculation there, a good example is if you have $800,000 in W-2 income or ordinary income, and capital gains of 400,000. So your total income for the year is 1.2 million. So that 200,000 above the million mark is subject to the ordinary income tax rates. So instead of the 23.8 on that 200,000, that's going to go up to 43.4.
Yeah. And so what types of ideas have you had or discussions have you had with clients about sort of, we've got a situation today where we've got people who have a lot of highly appreciated stock.
Absolutely. Well, first, you never want the tax tail to wag the investment dog. You want to make sure you're focusing on a long-term investment strategy and have solid investments for the long term. But when it comes down to really managing those gains and that exposure there based on some of these proposed changes, you can harvest more long-term gains here in 2020 and just accelerate that, as we've been talking about other topics as well. But also, this is where managing your losses each year becomes even more important, especially if you're potentially above that $1 million mark, because losses that you take, you can carry forward for years to come. And then you can help offset those future gains with those losses before. So that's another great strategy to consider, and making sure those are managed the proper way. But thinking longer term too, and just having an annual capital gains budget. as you start to look at your portfolio and some of these other implementations from the tax law changes, you want to make sure that if you are building a strategy that you're managing around that $1 million cap if you're pushing up against those levels. Another great idea is just where the power of municipal bonds, having federally tax exempt income definitely becomes more powerful and more valuable as well.
Right. Again, it's that's more of an investment decision and the
Yeah.
types of returns you can earn, which unfortunately in fixed income world right now, they're not very attractive.
Absolutely. And I guess the final note I'll mention, if there's control around your income, just increasing the use of installment sales. And if you have a transaction going through from a business standpoint, just thinking about how do you manage that, this is another way. So we do expect, if this does go through, the increase of installment sales to pick up as well.
Great. Okay. Any other items worth discussing that the viewers should keep an eye on as they sort of think about potential change in administration?
Yeah, I think the last one is the cap on itemized deductions, no more than 28%. This really doesn't have an effect on taxpayers within the 10 to 24% tax rate. Where this really comes into play if you're in the 32 to 37 today, or potentially the new 39.6 rate, where it's going to have a major impact on deductibility of mortgage interest, as well as even your donations as well. So thinking about the donation standpoint, if you earn $10,000 and then you donate $10,000, and you're in that 39.6% tax bracket, you're only going to get a 28% deduction for it, which is $2,800. But the unique thing is the tax bill on that $10,000 is going to be $3,960. So on your donations, you still may owe a tax bill, and in this case, it's going to be 11.6% of that $10,000. So a lot of things to consider here as you think about your charitable giving, what type of other deductions you might have, or even the mortgage interest, to understand how that's going to play into your net tax return when you do file.
So a lot of planning, a lot of opportunity to really look at your current investment structure and income structure and make some good decisions this year that could potentially help down the road, right?
Yeah, absolutely. And typically, in when these changes are proposed, we don't see the opportunity or the benefit of actually accelerating as much income, and now in this case, accelerating as many deductions as possible here in 2020. I mean, typically, the value of the deduction has generally correlated with the income tax rate. So the higher the tax rate, the more valuable the deduction, and vice versa. Well, this is a unique year where it's actually shaping up to potentially even accelerate that just based on some of the proposed changes here.